and CEO Jeffrey Gundlach. Jeffrey, welcome back. What a day to have you. You know, you tweeted going into all this today, quote, "I suspect Fed messaging will push back against the pivot narrative and thereby current bond market pricing. Should be interesting." He didn't really do that, did he?
He didn't really talk. I don't think he even mentioned the word pivot, frankly. He obviously talked about ongoing rate hikes, but there was just something about his demeanor after he read the statement. He just seems like he has confidence, I guess is what I'd say, and he feels comfortable in where he's gotten to. And I think that everybody kind of sensed that. And he obviously did not fight back against market pricing. He almost waved his hand about the disconnect. Somebody asked him a question about the disconnect between Treasury yields and the dot plot from last meeting. And he just sort of said, well, the bond market, you know, has its own ideas. And it's pretty interesting. So I thought that his demeanor was really the key thing. Remember back in August, Jackson Hole, I think it was, or September, he comes out like Apollo Creed predicting pain for the economy. And, you know, lots of unpleasant outcomes as a consequence of the need to catch up on raising rates. And I didn't hear the word pain at all today. I think one of the reasons that he's confident is he knows, as everybody should know, that and we've talked about this in past meeting appearances, Judge, that the CPI, the headline CPI, is coming down. And it came down from 9.1 to 6.5. What a lot of people don't know, over the last 6 months, the headline CPI has only gone up by 16 basis points per month on average. And if we just postulate that maybe that trend continues and we get 16 basis points for the next 6 months, the June number that would be printed in July would come out at around 2.5 on the headline CPI. And if we come in more at about 30 or 35 basis points, we'd be down at 3 for the headline CPI. So I think he's got a little, you know, he's keeping it under a bushel, but he knows that the CPI is coming down and he's using the word disinflation. The real question mark is going to be, when will the market start worrying about inflation in the second half of this year? Because it's quite possible that the inflation rate does go back up towards 4% in the second half. We just have such great base effects rolling off. And he's confident of that. He knows it's going to happen. We're not really going to get a bad inflation surprise before the next Fed meeting. And so he was feeling pretty relaxed. And the markets liked that. Go ahead.
Are you surprised? Are you surprised? Because, you know, the people that I've spoken with to this point, you know, really are hanging on this idea of this pushback against the financial conditions loosening, right? The market's rallied. There's a lot of the high beta frothy stuff that's rallied. He could have, he didn't.
He didn't, that's right. And it's pretty interesting because, you know, last year was so challenging. And we talked about in September that bond yields were going to peak in the fourth quarter and that markets were going to reverse in the first part of this year. And I expected risk assets to do well during January. And of course they have. It's odd how people don't really always factor in flows in the way they think about the turning of the year. Last year was so bad that we had tax loss selling all over the place. And so there was no liquidity to buy anything. And so the market was having a really hard time. And now people are buying things back. And now you're looking at your statement and you've got big numbers. You got the S&P up 8%. We've got the long bond, the Treasuries up 9%. You know, we've got emerging market equity up 11%. So unfortunately, I think that we've gotten a lot of return already for the first part of this year. And as we move forward a couple of months, I think we're going to start getting overvalued because I think this inflation narrative that is so supportive of markets, we're almost, I mean, I almost thought that Jay Powell was going to use the word Goldilocks at one point. He seemed so comfortable with where he was. Weird how he, at the same time, had this aura of relaxation, and yet he did still talk tough. Jobs not done, jobs not done. We have to raise rates more. We're not going to stop. We can't stop too early. But for some reason, the mood sort of trumped, and that rhetoric just didn't seem to have the teeth or the intensity that he had last fall. And I think that the market was relieved to see that.